Our last main stage presenter is Andrew Peak, co-founder and CEO of Delphia. Andrew is a serial entrepreneur and angel investor, and he's been making bets on technology backed by experimentation data and changing patterns of human behavior for like forever. um, he's worked at some of the most notable Canadian companies: FreshBook, Shopify, Jet Cooper, which he started and was acquired by Shopify, if I remember correctly. And I think I'm lucky to know Andrew because Satish, who was on one of our other events a couple of weeks ago, introduced us in 2016. And I've always been amazed about how you think ever since then. So let's start off by telling us what Delphia is.
Sure. Delphia is an asset manager, except the key difference is that we don't just manage your money on your behalf. We also manage your data. And we use the data that you decide to invest with us to improve your investment returns.
Cool. And what was your inspiration? Why did you start this?
We went through Y Combinator right around the time the Cambridge Analytica story was breaking, and it suited us really well. We had sort of known about this injustice going on with personal data, and we're looking for the best way to sort of empower the individual to take control over that asset. What we discovered along the way is you can't just pay people for their data. It doesn't matter what kind of industry or sums we're talking about. Your data individually isn't worth very much. But the aggregation of the data, the pooling of the data is what's extremely powerful. And so we went in search of what is the best, most lucrative aggregation of the data that we could give to the individual and share with them.
That's interesting. Tell us about the search, because I think you went, my feeling is you went through YC about 2 years ago, or it feels like 20.
Yeah, it does feel like 20.
Tell us a bit about the search and how you got to the current model.
Oh, I'm reading a lot of these war stories that go on multiple years, how Slack started from tiny spec and Superhuman was at it for 5 years, etc. Because Delphia is turning into one of those stories where the search for the best way to take advantage of your data is not to be taken lightly. It's taken us 2.5 years to this point, and we're just bracing on what I think is a groundbreaking product that maybe is 2 months away, 1 month away. And so we first found the domain space, which was, okay, well, we noticed hedge funds were using people's personal data to improve the investment returns of the wealthiest institutions and people in the world. And so we thought, oh, that's an untold story, but B, could that be recreated for the retail investor? And could we actively align that retail investor to the process? So instead of just, going around them to take their data, could we invite them to participate actively? Because then we could create a proprietary and even richer data set from which to do predictions. Once we established that, we thought we were a little Canadian about this. We thought the best way might have been to sell those predictions about these different companies whose sales we were predicting. We thought we could sell those to the world of asset managers and take that revenue and reward the people contributing the data. But the further we explored down that path, the more we realized we were never going to get fair value from those other hedge funds. And so about 9-10 months ago, we bit the bullet and said, okay, this has to be a closed loop system. We have to do the investing of your money for you as well. And so we became a registered investment advisor in the US and have now built out an entire investment arm, if you will, with portfolio management and quantitative machine learning expertise and whatnot. So it's not a small team. It's not a short story, and we're still in the very early innings, but it has been a fun exploration.
So, I guess they're trying to, consumers, I guess in today's day and age, when we talk about privacy, we talk about data. It's out there that data is valuable. Mm-hmm. But how have consumers reacted to your pitch? Like, do they overvalue their data? Do they say, do they not understand what I'd love to hear how this has resonated with consumers.
Yeah, so at the level of the injustice, my data is being exploited, you get a lot of resonance, but you don't get a lot of understanding. So people say, I know people are doing exploitative things with my data. I really don't know where to start in terms of taking control of that situation. If you double click down into the investment arena and just say, talk to Robinhood users, for example, they have a general understanding that markets are driven, I should say investing is data driven these days more than ever. And so if you can glean insight from credit card transactions or location data or social media data, which is really just public opinion, or browsing history, that's how you can get out ahead of earnings calls. And so they have a general understanding of that, and they know that they're the ones producing that data. So it's immediately intriguing to them to be able to use that data to their own advantage. And where I think where people really snap to and their eyes light up is when you explain to them how to do even better than Wall Street hedge funds. And the way you do that is you have to remind them that, when a Wall Street hedge fund is predicting based off your credit card data, all they see is your credit card ID, and they might have a few guesses about, male, what age bracket, etc., but they don't know very much about you. So if you invite that person into the process and they tell you about themselves in terms of, their sociodemographics, their attitudes, values, beliefs, ideologies, all these things, their opinions about the world, now you've got a very rich profile to associate it with that behavioral data, which allows you to do some pretty incredible things with machine learning.
So very cool. So, and do people, I guess, think their data is more valuable than it is, like from a monetary perspective?
Of course they do. Yeah, naturally.
Yeah. You got to pay me like $50 a month to get my data,
for
right?
For sure. And then we built a calculator once upon a time to show how much AUM, assets under management, Delphia would need to have to be able to satisfy some of these conditions. And it's not impossible to appease the average person who wants $50 a month for their data. However, it requires you to have a huge amount of resources that you're already managing and taking a cut of. And so you've got to build that machine before you can sort of give everybody the ticket they're looking for. Yeah, exactly. So for everybody else, though, the point is they don't need to wait for the payment. They can invest their money with us today and generate higher returns.
Cool. Gonna actually take a couple quick questions, and I have more I want to get back to. But Ananda said, "How do you overcome the regulatory hurdles to become an RIA as an early stage startup?"
In the US, it's really not that bad. In Canada, we're still going through the process because it is just a hairier process. It's just a very different landscape in the US right now. So we're trying to operate like a true high growth startup, and I hate to say it because I'm a proud Canadian every way, but we're singularly focused on the US market right now for the next little bit.
Makes sense. If you can operate there, go where big consumers and you're allowed to legally operate, that helps. I'm going to take a spin on JDip's question there. He's asking, what made you look at this more from a hedge fund active perspective? I'll ask. I take that tangentially related. One thing I've been reading a lot about is as people are sheltering at home, there's more and more day traders, and you hear about the Robinhood traders, and it seems lots of people are very active. Which, and then you hear about all these ETFs and passive income. So is it trend towards more active investing, more passive, and which one benefits you the most?
So you're highlighting these two camps that have emerged. In fact, I've heard a lot of people who are sports bettors have now moved to day trading with their free time. We don't hold strong opinions about day trading, but we understand that people are gonna pursue it. I think if you were to look at a retail investor in aggregate and look at the sort of expected returns from day trading, some will have hindsight bias for sure, where we talk about the winners. But as somebody who once lost their entire nest egg, trading double torque oil ETFs, I can tell you most of us don't win. On the passive side, there's a lot of interesting experts now who have seen more and more money flooding into these passive vehicles, and so it's really concentrating capital in some of the biggest names that you can invest in. I don't want to speculate what the effects of that will be, but really what we're offering is a very different model. So we're saying, a passive portfolio is generally just rebalancing based on the price of the equities within it. We're actively employing a team of data scientists to sift through not just market data, but all kinds of alternative data as well, including the proprietary data that we hope to generate in search of where we might have a little bit of alpha, or we might find a little bit of surprise that isn't priced into the market. And so that type of quantitative active investing hasn't really been made available to a retail investor before.
And then given the current market, the trends with data, how do you,
Mm-hmm.
you're taking a bold, statement to get in front of a few trends. How do you, what's the next step? How do you push it forward? And is the current situation with everyone at home and COVID helping or hurting?
Well, it's to be determined. I mean, people are going to cash. I think there's some folks who are going to cash, and then there are some folks who are fearing inflation and are putting money back into the market to ensure that they ride various asset classes higher. I
How about I want to change the question a bit. So lots of patterns are changing, right?
Yeah.
Like, I guess if you went back 6 months ago and you saw I was spending, I don't know where I'd spend, let's say, I was flying a lot and going here, and you could say this is a hot new destination. We should look at our, Alex is thinking a lot of boutique hotels. Let's see. And now patterns have changed. So as you're training your ML and AI models, how do you make sure they're effective and they're not just
So I think when it's really easy to choose passive when the markets are generally trending up as they've done for the last 10 plus years. You'd want to pay as little as possible to ride that momentum. I think everybody now is at an understanding that we've sort of hit the peak. The question is whether it's going to be flat or a downturn or what have you. Maybe there's a short run up, who knows? But the point is, you are going to need a bit more than business logic to figure your way through that. And so you're going to want to hedge out all kinds of risks, right? And so these types of strategies are generally not found in a retail environment. And I think COVID or the volatility of the markets actually plays to our favor a little bit.
And then I'll ask a couple quick hits there. One is from Lee John, who's asking, you're only available in the US App Store. I guess we already know that because you're trying to get regulatory approval here.
We're looking at partnerships, but
Okay. And then the last question is from Randy. But as a Canadian, what is your advice for entrepreneurs looking to grow a startup in the US? So,
I just think you kind of have to. Well, it's helpful to go down there. We went down there. We did Y Combinator, which was great. And then post that, we raised our seed from folks in New York, and I'm down in New York pre-COVID. I was down in New York twice a month for extended periods, and I think it's a mindset thing. I think if you spend the time down there, you'll end up having conversations, and you'll just realize the scale of thinking. And I hate to say it, but the scale of thinking is just bigger. It doesn't mean you can't do it from Canadian backyard. And I think, Toby and others have proven just how big that can get. So operationally, you can locate from wherever, but you need to be exposing yourself to, I think, some of that mindset.
That's awesome. I'm going to ask one last question and let you go. What do you think is the biggest opportunity with leveraging data and finance now, other than yours? So what's a trend that's about to merge?
Well, I'll tell you the factors that I'm interested in. So you've got zero commission trading, which is, now you're seeing everybody trade, right? So that lowers transaction costs in a way. You've got fractional shares, which are making their way through all of the broker dealers and whatnot. So now you can do long short strategies. You've got really cheap credit. You've got a change in the way that the SEC assesses risk and therefore how much leverage you can apply in a retail context. And so that confluence of factors, I think, makes for, you're going to see some pretty interesting products show up in the next 12 months, I would suspect.
Interesting. On that note, I want to thank you, and I really appreciate your time. And any founders that want to pitch ideas to either Andrew or I and how you're going to take advantage of those confluence of factors, we'll be happy to talk you through it.
Absolutely.
Thanks, Andrew.
Thank you. Take care.